Hello and welcome to Any Answers Answered for April 2023. Just a quick note to tell you that there is a free budget special that you can watch from Tax TV this month. Have a look on the PTP training website and you will find access to that, where Tim and I discuss the great and the good ideas from Jeremy Hunt in his first formal budget speech. But as ever, Tim and I have looked through the pages of Any Answers and have picked out a couple of questions to have a look at. Tim, we start with JCW8, who has asked this particular question. The question is about taxing company share buybacks. Can anyone advise, says JCW8, on the following? 100% shareholder has 10,000 shares at £1 each, and the company buys back 9,900 shares at par, reducing the shareholding to 100 shares. What, if anything, are the tax consequences on the shareholder? The shareholder has held the shares for 5 years, but was not the original subscriber of the company. Sufficient reserves, cash balances to cover the cost of this. Tim, I was about to say, what do you think? I'm fairly confident you'll say there's an easier way to do it.
Well, I know perfectly well, Giles, that you know the answer to these questions because you and I have been through exactly this sort of transaction ourselves, and indeed would suggest that what the shareholder in this case is doing is quite a good example of sensible, pretty basic tax planning. The first answer to the query posted on AccountingWEB basically says it all. Assuming that the shares were fully paid when originally issued, would this not just be a return of share capital? To which the answer is yes, and which is effectively tax neutral. There is no tax charge. And this is something that you and I did after having successfully set up and operated for some years our software company, Absolute Accounting Software Limited. And the benefit of financing a company with share capital instead of loan capital is that if the company fails, if the company in this question had lost the shareholders' £10,000 share capital, then you would be able to claim a capital loss, which you could, although interestingly not in the circumstances of this particular case, but in other cases you could set that capital loss against income as an income tax loss under share loss relief. The reason why in this particular question that's not possible is because we're told that the shareholder has held the shares for over 5 years, but was not the original subscriber. Now, that doesn't, in fact, affect the particular question being asked, but it would mean that if there was a loss, they wouldn't be able to claim share loss relief because one of the conditions is that you originally subscribed for the shares. But if you finance with share capital and you lose it, if you've subscribed, you can get that share loss relief. Whereas if, as is often the case, you put let's say you just have 100 £1 shares and put 10,000 in as loan capital and you lose that, the loss relief is not so generous. But going back to the particular example, yes, we are able, I forget since when company law changed. It used to be very difficult, well, not difficult, you used to have to go to the High Court to get permission to reduce a company's share capital. But now it's simply a matter of the directors signing a solvency statement, filing that with Companies House and reducing the share capital. And then the return of share capital does not give rise to any immediate tax charges. It does, of course, reduce the base cost of the shares by the amount of the capital returned.
As you say, something that historically was always done that way, and these days much easier to go for that cancellation of the share capital in many situations. Also, of course, takes out the traditional low share capital, high debt position that we often talk about, that you simply don't have to go for that these days. Our second question comes from Software Seeker, and I'm confident, Tim, you would be delighted to help a software seeker. We've got a new company changing their year end. I had to read this about 10 times to make sure I understood it. They're incorporating a business that seems to have potentially quite a short lifetime, and that's what's creating this issue. They're going to start, or they did start, 5th of January this year. The default setting is therefore 31st January 24 for a year end, just over a year later. But their profits for the first 3 months up to March will be about £90,000, then another £90,000 for the 3 months after that. But Software Seeker seems to be suggesting that could be it. The question therefore is, we're looking at 180,000 over 13 months, but if we change our year end to March 23, that would pull 90,000 before that date, 90,000 then in the second part. Is that the better option, they say? Because then you would have the first 90,000 all at 19% and the new rates kicking in for just half of the overall money. Tim, what do you think?
Well, this is an interesting question, which I think will be of interest to quite a number of AccountingWeb members, because as we move into the higher tax rate regime from 1st April 23, well, taking a simpler question, what if you've got a long-standing company with a 31st December year end? What do we do as the rates change? And the answer is actually very simple. The accounting period that straddles the 1st April 23 is divided into two corporation tax accounting periods, 3 months ending 31st of March and then 9 months to 31st December 23, with a straight time apportionment of the profits between those two CT accounting periods. And for those that are interested, that time apportionment is prescribed by section 1172 of the Corporation Tax Act 2010, which says any apportionment to different periods, blah, blah, is to be made on a time basis according to the respective lengths of the periods. And we had a query from one of our delegates about using a just and reasonable apportionment instead. And they referred to a case involving the big shipping company Maersk. I don't know if I've pronounced it correctly, but research shows that in fact the Maersk case was based on legislation in Finance Act 2011, which does allow a just and reasonable apportionment, but only in respect of the supplementary corporation tax charge in respect of ring-fence trades. And it doesn't impact on the normal application of section 1172, which does impose this strict time apportionment. So we do need to time apportion. Now, turning it to this particular question, we're looking here, if you disregard the odd 5 days at the start of trading in January or start of January before trading commences, we're looking basically at a 13-month period to 31st of Jan 24, in which the profits will be 180,000. And if we don't do anything, then that 13-month period will be time apportioned, and roughly speaking, 40,000 of the profit would go into the first 3 months and be taxed at 19%, but the other 140,000 would be subject to the new corporation tax marginal rates. If instead, as suggested by Software Seeker, the first period is a 3-month period to 31st of March, then the whole of the 90,000 in that 3-month period will be at 19%. The remaining 90,000 will be in the 12 months to 31st of March 24, and some of that will be at the marginal 26.5% rate. But the overall tax liability will be reduced by that strategy by about, well, it's something of the order, I haven't worked it out exactly, something of the order of £5,000. So when Software Seeker says, looks like taxable profits have shifted from a higher to a lower tax rate, am I missing something? No, you're not, Software Seeker. You're absolutely right.
Of course, this is potentially interesting for any number of these businesses that have relatively short lifespans, less than a year, because it could result in us potentially saving money. But we must remember that the 250 bands will be reduced down on a calendar basis as well. If it's not a 12-month period, we also have to remember to make that adjustment.
Let me just say, I don't think it affects this particular example because of the way in which you're going to split it into a 3-month and then a 12-month, and the profits are simply going to be the same in the 12 months, whether it's the year to 31st December 24 or to 31st of January 24, because that contract comes to an end.
Yes, absolutely. I appreciate that in this situation, but more generally, this is something that we must consider in terms of that time apportionment of those bands. Hopefully useful. Do keep posting on any answers, and perhaps next time it'll be your question we have a look at. For today, bye-bye.